All right, well, I'm doing a short extra lecture, and I'm just going to post this for both classes that I'm teaching in the spring of 2021, the investments class and the derivatives class. Just 'cause I've gotten a lot of questions about GameStop, and um, there are some things with respect to GameStop that do what's happened in the past week that actually do relate to our class. So I just wanted to run through them a little bit. I'm going to talk about the short selling mechanics. Got a lot of questions about that, especially in 335. Turns out this week we talk about short selling a little bit, so it's perfect there. In a week or two, I'm going to talk about risk-defined trading with options. People think of options as being very risky, but I'll actually show you a trade that I did this last week. It didn't turn out as well as I'd hoped, but that's okay. It's a good teaching lesson or a good teaching example, but it'll show something that I did in a small size of my personal account, based on an outlook that the thing with GameStop was overdone, and I did it in a way that allowed me to stick with the trade even when the stock had gone. I put the trade on when the stock was around 327, even with the stock up around 490 or so. If I already knew what my maximum loss and my maximum gain was, so I was able to uh, not give up on the trade due to a short squeeze. And we'll talk about what a short squeeze is as well with part of the short selling mechanics. Why did the brokers do what they did? I'll explain why a broker would restrict trading or raise margin requirements. It's actually something that happens a lot. I just think that younger investors slash traders, however you want to classify yourself, had not experienced this in the past, and if especially when something like this happens and it is detrimental to you, you take it a little bit personally. I can understand that. What I think happened to the rest of the stock market, and there are differing opinions on this, but it's a good chance to explain why something that happens even just in an individual stock or a small group of stocks or a small part of the market can actually have an impact on the rest of the stock market. And we'll touch a little bit on potential regulation because you're going to start seeing things like that kicked around. Now, as far as selling short, we all know that you buy low to sell high. Well, you can try to sell high to buy back at a lower price, and that is what a short seller is trying to do. And mechanically, in this day and age, if I go to short a stock in my brokerage account, I click a button and boom, I have a short position. Well, what really is going on is as the short seller, I am borrowing shares from someone that holds them, and I'm selling them to somebody else. And if I'm borrowing them and selling them to somebody else, then at some point I will need to repurchase those shares and return them to the shareholder. So that is the full cycle of the short selling process. Now, the way that I return the borrowed shares is I send them back to the shareholder. Exiting the trade is, when I will go about, when I will go about returning the shares, and there are different scenarios that would result in me choosing or being forced to return the shares to a shareholder. Now, first one, let's say I shorted a stock at 100 and it goes down to 50, and I'm like, well, $50 is I think a good value for the stock, or it's a place where I think the move is done. I've made $50 times however many shares I shorted. I'm happy with my profits. I cover my short. I buy the shares back and I return them to the shareholder. Now, that's the good one. The next two, not as good for the shareholder. Now, there can be an instance where the shareholder asks for their shares back. They want to sell them. They want to get out of the stock, so they ask for their shares back. And if my broker on my behalf cannot find another place to borrow shares, well, then I'm going to have to buy them back and return them. And this is actually something that a large shareholder could do if they, they can just ask for their shares back. They can say, I don't want to lend them out anymore, or they can ask for them back because they're going to sell the shares. That can actually prompt buying in shares. That is one way to go about forcing some buying in the shares. Now, the last one is a lot of what we've been seeing at GameStop lately. And this is a long, drawn-out explanation here, but basically, this is repurchasing the shares. I'm a short, and I don't have enough capital to maintain the short position anymore. My broker does want me to have cash on hand to make up for any unrealized losses, so that the brokerage firm doesn't have to end up dipping into their own money to handle any losses that I incurred on my short sale. Also, if I am working at an institution, just, you know what? I shouldn't even say most. Every institution that I ever worked for, either just an outright bank trust department or the small number of hedge funds that I worked at, we would have risk controls in place. You can't take more than a 20% loss off of a single position, or you have to start to reduce the size of the position. Well, reducing the size of a short position would be buying the shares back. If I am running out of capital that I need to maintain my short position, I might need to repurchase the shares. If I don't have enough capital, according to the rules of my brokerage firm, to maintain my short, they actually have the right to buy the shares back on my behalf. And again, that's to protect themselves against more losses than the amount of money that I have in my account. That also protects their other clients. So some of the actions that the brokerage firms took are, protecting themselves as a running entity, and they're also, for the long term, good for the overall financial system. Now, this last one, it can be thought of as what we refer to as a short squeeze, and we've heard that with reference to GameStop, AMC, a few other stocks as well. And stocks that may experience a short squeeze are typically stocks that have a very large short interest. And short interest is how many short positions are there as a percentage of how many shares outstanding. There's a great free website, highshortinterest.com, and I pulled their graphic from Friday morning for this lecture. You can see that GameStop, the short interest is 121% of their outstanding shares. There's almost 70 million sold short with 50 million float. And one of the big questions I've gotten is, how is that possible? Well, it's possible for a few reasons. It's not something that should persist for a long period of time. But sometimes a bona fide market maker may take a short position. In those of you in my options class, I've showed you how when an option trade occurs and a market maker is on the other side of the option trade, it will prompt a trade in the underlying shares. Also, if there's a certain number of days, and I don't want to get too technical on it, but there are a certain number of days where if you don't have the shares but you have a short position, you have the ability to go out and try to find shares and borrow shares. So there's kind of a systematic lag that's going on there, but that number should eventually get under 100%. There are mechanisms in place that will push that number lower. And I'm sitting here on Friday, January 29th, that number should be under 100% within the next couple of weeks. But one of the ways that we get that number under 100%, people buying shares. You can see some of the other stocks that have been in the news were listed as stocks with a high short interest. And those have been popping up as well as people are trying to find the next GameStop, the next once-in-a-lifetime stock. However, and again, I want to stick with things that relate directly to the classes. And in 335, I will talk about how GameStop may have been a justified purchase when it was around $4, because the short selling story may not have been as severe. And one of the people that has kind of popped up as a person that was talking about this on Reddit, if you see a video he made back in maybe September or August, he actually does lay out a pretty good fundamental argument for purchasing shares of GameStop and how the company's not going to go out of business. One thing that I've always found kind of funny in my career is when I've worked at places where we short stock, you'll take a short position in a company and the stock might start to come under pressure. That doesn't mean management's just sitting around doing nothing. And GameStop management had been, closing stores to lower costs because of what's happened with the pandemic. I believe they've been increasing online sales. So that's helped them out as well. And there are certain things that I think gamers like to actually try out before they purchase. So GameStop will probably continue to be some sort of functioning entity. And I've forgotten his name off the top of my head, but he doesn't dress terribly professionally, but man, he is very articulate and lays out a really nice argument about GameStop and why it might have been a purchase. So just because a company has a high short interest does not mean that a bunch of traders on Reddit can get together and cause the stock to rally to the upside. There does need to be some sort of fundamental argument, and that's why I think that we've really only seen the move that we've seen out of GameStop and not some of these other stocks with really high short interests. And I think it's pretty short-sighted to go buy AMC unless you're doing it for a very short-term trade just because they have a high short interest. We all will eventually be going back to the movies. So there. So I actually did a trade on Wednesday and I told both classes that I had taken a short position in GameStop, and it was not a recommendation. It was just I did something in options and I did a very risk-defined trade, and I'm gonna lay out what I did. I do want don't, if you're in 335, don't fast forward. I'm gonna talk about this a little bit more as we go through class. But when Wednesday morning, the stock had popped up to the 300s. With the stock at 327, I put on what is referred to as a bear call spread, and I got really lucky with the execution. I sold the 310 calls that expired on the close on the 29th. And I sold those for $87.50, and I bought the 320 calls for $78.65. And the net result here was I took in a credit of $8.85. And those of you that know options real well, you can look at this and say, well, he can make $8.85 or he can lose $1.15. So I kind of liked the risk reward here. And these things are shown very nicely with payoff diagrams. You can see anywhere. In fact, let me get my little pointer. There it is, my spotlight. So the stock, that's not the spotlight, that's the spotlight. Okay, so the stock was about here. And you can see the stock was at a place where I would incur a $1.15. That says profit. That should say loss. Oh my goodness gracious. Now I have to go over and do this. No, that's that it's got a minus, so you know what I mean there. Well, that's not even helping. I'm just trying to get rid of that word. All right, so that should be that right there should be a loss. So we know that it's got a minus sign there. So 885 profit or a loss of $1.15. And again, the stock was right about here when I put the trade on. And the stock went well above and well below that 320 profit or that 320 price level where I could incur losses. I mean, it could go, the stock could have gone to 5,000, which, I guess some people probably predicted. But the most I could lose was $1.15. And the most I can make is 885. I pulled a chart that shows the 15-minute price action in bars over the whole course of last week. This bar right here is where I actually put that trade on. And hold on. And this is right about where I put the trade on. You can see it went well above and it went well below. It just kind of went back and it's all over the place. It did close a little bit above 320. I did exit the trade before then and made a small profit. But if I'd held it through expiration, the stock closed at 325 on Friday. I actually would have taken on that $1.15 loss. But the point is, if you had sold short right here, you'd have gotten squeezed right there. In fact, I think it went up to about here in the pre-market trading. But I would have, if I'd put this trade on here, and I did, I put on the option trade, but I put on the, if I'd sold short, first thing, if I'd sold short, I would have been staring at the stock from here onward until I got out of the position. This would have been a heck of a time to have that short position on, and I probably would have gotten squeezed out of my trade. But the fact that I put on a structured trade with a structured outcome, a known profit and a known loss, allowed me to hold the position through Friday afternoon. And because I'm teaching during the day, I'm doing consulting during the day, whenever I have the rare time that I actually do a trade on a stock, I will always use this type of structure where I know what my maximum loss is, so I'm not fixated on what's going on in the underlying stock. Now, the brokers did some stuff. Some brokers increased margin. One broker said, I don't think you're allowed to have any entry trades into the stock. This is not something that is unusual at all. In 2008, out of nowhere, and it wasn't the brokers, I think it was one of the regulatory entities, gave us a list of financially related stocks that we suddenly couldn't sell short. Right in the middle of the financial crisis, and they changed that rule a few days later, just because there were it was causing more trouble within the financial system than it really should have. It wasn't achieving what they had hoped that it would achieve. So we see margin requirements go up during periods of excess volatility. Margin requirements for a lot of markets, a lot of macro markets, went up back in March of 2020. So this is a common action when we have excess volatility, and something that you probably should have in the back of your mind if you're involved in one of these stocks. It's something like this, or you're involved in the markets when volatility starts to go up. We do see an increase in margin requirements. Not allowing trading is a bit extreme. I'll cite one broker. I really shouldn't, but I will anyway, because I think their action was a good idea. Interactive Brokers, I don't know exactly what stocks they decided to do this on, but they said you couldn't buy a stock on margin anymore. If you purchase shares of GameStop, for instance, you had to have you couldn't buy that on margin. You had to have 100% of they said 100% margin, which is the same thing as you need to put up all the money to buy the shares. And they said that you needed to have 3 times the dollar amount of certain stocks in your account in cash if you wanted to sell short one of those stocks. So if you were thinking about selling short GameStop when it was at 100, you'd need to have $300 in cash in your account to protect against the stock going up threefold, which I'm not going to go back to that chart, but you can see that was not out of the realm of possibility last week. But suspending trading is extreme. A better action, I think, is just increasing the margin requirements. And, we didn't see it because we only see what's going on with the retail brokerage firms that impact individuals, it's very possible that some of the hedge funds that had positions in stocks like GameStop, especially short positions, they may have had to put up more capital as well. But that's not as public as something like something that gets the guys on CNBC all excited when Robinhood suspends trading and Interactive Brokers raises the margin requirements an awful lot. This is it is most definitely an action that should be taken. It's protecting a firm that employs a lot of people. It's protecting all of their clients, the ones that have positions in these stocks, but also the people that don't have positions in these stocks. If I have money at a brokerage firm that basically goes out of business, which because other traders at the firm, other people with accounts at the firm take on positions that I haven't even taken on, that's just something that is not it's not particularly fair to me, and I would count on my broker to protect me against the actions of others. So I think the broker's actions, all of them were well intended. I will say that for a multitude of market participants, not just the ones involved in those individual stocks. Now, the ripple effect. I got a question in class why, and I actually had two reporters reach out to me on this one last week. Why did the stock market sell off when GME shares were rallying? Well, some hedge funds had to raise cash, either due to the large losses or potential redemptions that were coming. So this was all happening during the last week of January, and I just say the last week of January because many hedge funds only allow clients to take funds out of, to ask for redemption or get the money that they have in the fund at the end of each month. Some of them only allow you to do it at the end of each quarter. But I think that I think what was going on happening during the last week of a month may have exacerbated the situation, but also resulted in hedge funds having to raise cash. In fact, at one point, I believe, and things were moving around so much but I do know at one point I saw the Nasdaq was down a lot more than the S&P 500 or the Russell 2000. And keep in mind that last year, big tech stocks, in that's what the Nasdaq 100 really does represent. Big tech stocks were the big outperformers. And since they were the big outperformers, if you're looking to take profits, those are the kind of stocks that maybe you're looking to take profits from. So raising cash for potential withdrawals, raising cash because you're incurring large losses on some of your shorts, maybe some other stocks beyond GME, because everybody was, people were looking to buy heavily shorted stocks, thinking that that there was going to be that there were going to be more stocks reacting like GameStop did. So funds being forced to sell stocks to raise cash are just because they needed more margin to cover their GME losses. I do think that had an impact on the stock market. That happened on Wednesday. Some rules changed around. And Thursday we had a nice rally, but then on Friday again we had the stock market sell off, and I'm going to say some of that selling was related to having to raise cash. So there are other reasons that people might not want to be buying stocks right now. So what's going to happen next? I'm sure there are going to be some hearings. I've already seen where I think there are going to be some hearings in DC about this. This is common when we have extreme market moves that hurt certain people or are headline catching. I'm not really sure that we're gonna say, often we see new regulations every time something like this happens. We had lots of new regulations after 2008. I don't think this is the game changer that a lot of people in the financial press are making it out to be. I think this is a individual situation. I would encourage you to go and I'll see if I can find the link. I'm going to put this on my little YouTube page as well, so I might put the link below this. But the case for GameStop not going bankrupt and not going out of business was it was laid out very well, and so I'm not 100% sure that uh, there are a whole lot of other situations like this out there, and I don't think this is going to be quite the game changer. But I did find, this is my final slide here. I did a Google Analytics search, or I looked at Google Search Analytics, and I thought that it, you can score a search term between 0 and 100, and you can see that they have a preliminary number out that had GME, the ticker for GameStop, popping up from around 25 to 100 in the last week, but the subregion or the state or the part of the United States that the only one that scored 100, District of Columbia. So there you go. I think that right there gives us an indication that hearings and regulators checking this thing out, not necessarily saying it's going to result in anything. I think that is in our near future. So with that little bit on what happened on GameStop, trying to explain it, not from here's how you make money on it, but how to, how this played out with respect to some of the things that come up in the 2 classes that I'm teaching this semester. And I know I sent it out in an email, but do keep in mind, there are a couple of homework questions that are related to this lecture for both classes. So with that, I'm hitting stop recording. Fingers crossed this worked, and I'll see you guys next week.